Jamie Dimon weighing in on JP Morgan's earnings call, saying the independence of the Fed is absolutely critical, not just for the current Fed chair, who I respect, but for the next Fed chairman. And our next guest says this is another soft read. He still expects the Fed to cut by a full point this year. Let's bring in Barry Knapp of Ironsides Macro. Barry, it's great to see you. This has to be like a curriculum in a box here. Why do you, and I'm sympathetic to this, but again, the bond market's not acting like we can look through all of this inflation. Look at the 30-year today, right? Look at the 10s. Do you think that's all global? So where does the dovishness come from?
Yeah, there's a lot in your intro here, Kelly. As far as the Treasury market specifically, the pressure really isn't on the back end today. It's really in the belly of the curve, and it's the real rate component or TIPS yields. I think that has to do with the monetary policy outlook, this idea that inflation is coming from tariffs. I think that's totally wrong. As we discussed last time I was on set back in June, inflation is always and everywhere a fiscal and monetary phenomenon. So if you just consider the conditions that exist today versus 2021, I look back at the CBO budget report in March 21. Spending was up for the first 6 months of that fiscal year 45%. Right now, it's up 5%. That's slowed from 7%. And on a month-on-month basis, it was down 7%. So fiscal policy, the sending of checks to everyone that facilitated the big spike in goods prices during the whole COVID supply chain related disruptions, is in the opposite position it was back in 2021. The same is true of monetary growth. Money supply was expanding 27%. Right now It's expanding 4%. So 50-year average is 6-7. So we're not going to get a big inflation surge here. And I think we're going to see very soft growth numbers over the next month that are going to convince the Fed that Waller's right. You know, that as the dust settles or dirt settles, as Goolsbee put it, the Fed should have been easing and will find themselves behind the curve in September, just like they did a year ago. If
so, would you say we should all be buyers of bonds here, that these rates are coming down? Or do you think they're high because of what's going on with the debt and deficit or what's going on with the independence, quote unquote, of the Fed?
Well, for the it's funny, I gave a speech to a bunch of energy CEOs in Denver last week, and my net takeaway was still that you should be underweight the back end of the Treasury market. I've been at 70-30 all year, 70% stocks, 30% bonds. There are some other things going on in the back end of the Treasury market, for sure. I mean, the JGB market, which has been the anchor of global bonds, as Peter Bookvar puts it, for decades, is under a great degree of pressure. They have upper house elections next week. The slowing of QE is a huge problem in Japan, the spending out of Germany. So there's a lot of pressure on the back end of the curve. It's unclear how Treasury Secretary Bessent is going to approach the financing. I'm not worried about the deficit expanding here. And as I said, government spending is easing. But the back end of the Treasury market is still not where I would be. I would say probably the 2-year to 5-year part of the curve probably represents a really good opportunity, because if I'm correct and we get a really weak core GDP number at the end of the month, we get another 4th consecutive big negative revision to the benchmark estimate for payrolls for the year ended March. We get another weak employment report where the internals are really soft like last month. The Fed will find themselves behind the curve and will have to play catch up, in which case, if you bought 5s, you'll do really well.